Self-employment taxes can take a huge bite out of your business profits. If you own an LLC, you might be paying thousands more in taxes than you need to. Today, we're exploring legal strategies to reduce your LLC self-employment tax burden. As a business owner, you enjoy many freedoms. No office commute, no boss looking over your shoulder, and no corporate dress code. But these freedoms come with a significant cost: self-employment taxes that can consume 15.3% of your hard-earned income. The good news is that there are legitimate ways to reduce these taxes. One of the most effective strategies is electing S Corporation status for your LLC. This approach allows you to divide your earnings into two components: a reasonable salary and distributions. Only the salary portion gets hit with self-employment taxes, while the distributions remain exempt. Here's how it works. You pay yourself a market rate salary for the work you do in your business. This salary is subject to the 15.3% self-employment tax, but any additional profits can be taken as distributions, which avoid self-employment tax altogether. This structure can lead to substantial tax savings. To make this election, you'll need to file IRS Form 2553. It's generally best to make this election early in the year to maximize your tax benefits. Let's understand what self-employment taxes actually are. When you work for someone else, your employer pays half of your Social Security and Medicare taxes, and the other half comes out of your paycheck. But when you're self-employed, you're responsible for the entire amount, hence the term self-employment tax. Social Security taxes are assessed at 12.4% of your income up to a certain threshold, which changes annually. Medicare taxes add another 2.9% with no income limit. Together, these make up the 15.3% self-employment tax rate. You may be subject to these taxes if you're a freelancer, independent contractor, sole proprietor, general partner, or a member of a single-member LLC. For these business structures, all business income is typically considered earned income and therefore subject to self-employment tax. Choosing the right LLC structure is crucial for tax efficiency. A single-member LLC taxed as a sole proprietorship is simple, but exposes all income to self-employment tax. An LLC taxed as a partnership offers more flexibility, but general partners still pay self-employment tax on their share of earnings. An LLC taxed as an S Corporation provides significant tax savings opportunities, but requires compliance with payroll rules and additional IRS filings. Meanwhile, an LLC taxed as a C Corporation avoids self-employment tax, but can result in double taxation on distributions. Not all business income is subject to self-employment tax. Rental income from real estate is typically exempt unless you're classified as a real estate professional. Investment income such as dividends and capital gains also escape self-employment tax. Retirement payments structured as planned distributions rather than business income can be exempt as well. LLC owners subject to self-employment tax must make estimated tax payments throughout the year. This involves calculating your expected income and tax liability, then submitting quarterly payments using IRS Form 1040-ES. Failing to meet these obligations can result in penalties, so careful planning is essential. The tax treatment can differ depending on your role in the LLC. In a single-member LLC, all income is typically subject to self-employment tax. In multi-member LLCs, active members pay self-employment tax on their earnings, while passive members who don't materially participate in the business may avoid these taxes under certain conditions. Remember that the IRS requires any salary you pay yourself through an S Corporation to be reasonable for your industry, location, and role. Setting an artificially low salary to maximize tax-free distributions can trigger IRS scrutiny and potential penalties. To legally reduce your LLC self-employment tax, consider electing S Corporation status, properly classifying different types of income, understanding which LLC structure best suits your situation, and ensuring you're making accurate estimated tax payments. With careful planning and proper structuring, you can significantly reduce your tax burden while remaining fully compliant with IRS regulations.